You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That tune means it's time once again for Volatility Views, the premier program for volatility traders. And my name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs, 15 to be precise, for you guys to mainline straight into your ears. And, of course, the easiest place to find all of that goodness, theoptionsinsider.com. While you're there, of course, some breaking news on the options market, some great educational, analytical, and unusual activity articles for you guys to consume at your leisure. And when you're ready to begin your audio journey, click on the Insider Radio Network tab, and there you go. You're off to the races. All nearly 10 years worth of content available at your fingertips if you want it on your device of choice: iTunes, TuneIn, Stitcher, Google Play, Podcasts, iHeartRadio. I'm sure I'm forgetting a few there, but it's available on all the major outlets. Add in new ones all the time. So if you have one you'd like to see us up there on, it's a Portuguese iTunes store, whatever the case may be, hit us up, let us know. And of course, you can always get us via our own app as well in the Android and Apple and Amazon Fire app stores. And of course, every Friday, noon Central, 1 p.m. Eastern, you guys can join us live via Mixlr, M-I-X-L-R. We always tweet out the link, so make sure you follow us over there at Options so you can get the link or get it on our website. Once you get it once, just bookmark it. It's the same link every time. Or just follow us on Mixlr. Again, also available on pretty much every device imaginable. So if you want to listen to us on the go, you can do that as well. And of course, while you're streaming, while you're downloading, however you listen to us, we love to hear from you guys. Send in those questions, send in those comments. We love to hear from you guys. And of course, this program brought to you by our friends over there at CBOE Live Vol. Like the man said, head on over to livevol.com. We're always talking about great data here. Check it out for yourself. 15-day free trial costs you nothing. So all this great data we're talking about, check it out for yourself, livevol.com. And kick the tires. See if you want to light the old fires. I believe that's their tagline, isn't it? Mr. Russell Rhodes joining me in studio, of course, the senior options instructor over there at the Options Institute, fresh off the boat, back from Dublin, Ireland. He looks very well rested, listeners. Mr. Rhodes, Mr. Rhodes, happy to have you in the studio in your fine CBOE livery, sir. Looks great.
I didn't even realize I was wearing a trading jacket until you just pointed that out.
You're that guy. It's just unconscious to you now.
I'm that guy. So let's light this candle. Remember the Stewart commercials back in the day?
That's also Top Gun, isn't it?
Yeah, well, we should bring Stewart. We should bring Stewart back for. I guess I could be the old guy in the commercial for a series of live vol commercials.
We could do that. That'd be interesting. Or maybe Baby Bob and just have him talk live vol instead. Well, all kinds of fun things we could do. Speaking of babies, we are also joined by he who may be on baby duty, we don't know. Yeah, he is a greasy meatball himself, Mr. Mark Sebastian, beaming in from the Option Pit World HQ by way of scenic and sunny Riverside, Illinois. Mr. Greasy Meatball, welcome back to the Volatility Views program, sir.
Great to be here. Yes, it's a lovely day here in Riverside. I had to drop off my car because my sensor on my tire isn't picking up the fact that it's full. And then, of course, I dropped off the car. I take one step outside, and it starts pouring on me. Luckily, the walk home is only 6 blocks, so I'm probably not going to get pneumonia.
See, the way you avoid that is you just be in the studio here all day. You never go outside, and then these things like weather are just random factoids that have no bearing on your life because in the walls all day, recording away. All right, with the team assembled, let's dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, listeners, it's an exciting time here on the old Volatility Views program. A couple of times a year, all the volatility world's best and brightest gather at a couple of different events. One of them is, of course, the Risk Management Conference here in Florida, which we have discussed here on the network in the past, but they also do it overseas, across the pond, if you will. Over there, I believe it was in Dublin this year, scenic Dublin, Ireland, once again, where CBOE held their European arm of the Risk Management Conference. If you're familiar with risk management, of course, it's where a lot of researchers and practitioners get together to share ideas and strategies and break down what works, what doesn't in the world of all things VIX and SPX and everything else under the sun, BXM, a bunch of other things, Russell, all sorts of other fun things. And luckily for us, Mr. Russell, fresh off the boat as he is, he's fresh off the boat from Ireland, where he just came off from the big conference. I know, Russell, you've been kind of knee-deep in research and papers and analytics and talking to traders all week long. So you're just full to the rim with all sorts of great nuggets from RMC. So have at it, sir. The floor is yours. A lot of our listeners couldn't make it out to Ireland, so let's give them the lay of the land. What were some of the compelling stuff, the interesting research, the great topics, the hot discussion points over there at CBOE RMC Europe?
Goodness, I could go on for the whole show, and that would allow Mark Sebastian to just warm up a little bit, get toasty by the fire.
I had you allocated for about 38 minutes. Is that enough time for you?
I could do, and hopefully Mark will feel better by that point. I'm feeling for him. Risk management, the first day is always kind of, it used to be a purely educational day, but I think the level of the conference has just been elevated over the past few years, especially even in the 5 years that I've been going. And this was our 5th one over in Europe. The first session was all CBOE stuff. It was Bill Speth, who is always the smartest guy in the room. He's our director of research and product development. And he started out, he was talking about a few trends that we see in the markets. He said that, and I think we see this as well in some of the things we talk about here, the demand for passive investments just continues expanding. I love that he and I were chatting before he got going, and he actually used the phrase smart beta as it being the fastest growing area of passive investing. And I think I'm the only one at CBOE that says this, but I actually do believe it. We came up with the buy right index like 15 years ago, and I think that was the first move into what you could call smart beta.
Yeah, there was an early foray into that arena. You're right. That's kind of a hot buzzword now, but you don't think of BXM. Yeah, but you're right. It was kind of almost too early for that to have that buzzword applied to it.
It was ahead of its time.
Ahead of the buzzwords.
But and our strategy indexes, this was actually the first time in a CBOE presentation that I'd seen the phrase smart beta used. But I've always thought of a lot of the strategy indexes that we've got out there as being, falling under that term. So it's kind of like we were geeks before geek was cool or whatever. Well, we were smart beta before smart beta even had a title. In this theme came up. Andy Nybo mentioned this. I think there were several themes that showed up in several presentations, and it was just that the stock market is being looked at as a single asset class. It's not individual stocks, and because of that, you're continuing to see an expansion of use of index derivatives, either volatility index derivatives or SPX or RUT index derivatives. The things that Speth talked about specifically, he talked about the Russell 2000 Conditional Buy Right Index. I think everybody's somewhat familiar with that. It's got some rules around it. And then he talked about some new stuff, which is why I'm talking so fast, because I want to slow down for a second. We are, any day now, we are going to formally introduce the CBOE S&P 500 Smile Index. It was talked about at Risk Management, so it's not a secret. Basically, it takes the shape of the skew of the SPX and alternates between doing a short strangle or doing a, when we're in flat skew, or doing just a short put versus a short. When flat skew, we go farther out, or we stay closer in than in when we're in a little bit more accentuated skew. And it just the strangle that's sold is actually conditional on the symmetry of the SPX. I don't know if the rules are fully out there yet. That's why I paused for a second. I'm like, I think it's still a work in progress.
So this is obviously going to be different than your skew index, which people may be familiar with now, that CBOE currently disseminates. That's kind of just a passive index that you're measuring, the calls and the puts and measuring that risk reversal to get the skew. This sounds like this is going to be much more into that, dare I say, smart beta, that more active side of the fence where you're adjusting, like you're mentioning, you're adjusting the strangle based on the conditions of the volatility skew, which is interesting.
Well, I misread here. The Smile alternates between a risk reversal or a short strangle depending on what's going on in the overall market. So it picks one strategy versus the other. We show we compare it to just owning having the total return of the S&P 500. Since inception, it's outperformed. It has much less volatility than holding the S&P 500. And when that gets formally introduced, we'll talk about it again here. But we'll put more of the details up on our blog site as well. He talked about VEST because VEST is and that in conjunction with our target outcome indexes. We've got right now we've got two target outcome indexes. One that's the Buffer Protect Index and one that's an Enhanced Growth Index. A third one is coming out any day now that's going to focus on income. I interviewed Speth a little bit later after his presentation. He said that the income version tends to return around 5% or so a year with fairly low volatility. So we're in the process of bringing out a third. But Vest is the firm that we've teamed up with, and they tend to, what they like to say is they sell the cake, not the recipe. And then we light that candle.
I like that. We met with the Vest guys back at OIC. It's interesting. And you're right. It kind of, for people, maybe a money manager who's hearing this stuff and they're being like, oh, man, that's over my head or whatever. They don't want to handle the execution on that, which obviously could be a little bit dicey. You're talking about swapping from risk reversals to strangles and vice versa. And some of the other products here that, the best product is pretty much, I wouldn't say plug and play, but you enter your what you want and it kind of spits out what you need to do, which is I think, a nice palatable solution for a lot of that middle of the road money managers who are savvy enough to know they need to do this, but maybe don't know exactly how to do it themselves.
Now, and I actually think the term plug and play is pretty good. Yeah, I mean, you say I want to protect against 5%, the next 5% downside in the S&P 500 because I think we're going to pull back a little bit here, but I don't want to pay anything for it. And they'll show you how maybe you can do something like that with buying a put spread, and then you can go up almost 10% and sell a call option to pay for that. And that's the sort of solution that they come up with. You can give them any scenario, and they're going to be able to come up with some sort of a solution for you. And then finally, Speth talked about something that I'm very interested in, the social market analytics index that we started doing, where they where we basically take the 25 highest rated stocks based on Twitter chatter about 20 minutes before the market open. We say you buy it on the market open, you sell it on the market close, and that sort of strategy, and in fact, I mean, that strategy has worked fairly well over the last 2 or 3 years since basically over the time frame that we have data for it. But I was talking to Speth again about that, and he said it's not just buying those stocks off the open. You actually can, it's actionable for the first hour or two during the trading day as well, which I found somewhat interesting, that you just don't have to be in there at the very open. You can maybe let that open volatility calm down a little bit. And I think it's a good indication of how the social media, because Twitter is a great tool for people in our business, and it has become a leading indicator for movements in certain stocks.
Isn't it terrifying how people will fire off massive deltas based on one tweet, which could be errant or aberrant or all sorts of other things, and yet they're going to move markets. But that's interesting. The social, you guys kind of just announced those indices not too long ago, so we're planning on effectively tradable products coming in down the road in the near future, you think, for these?
That's very possible.
Really?
The next SMA version, right now we've got 25 stocks, and it's rebalanced every day. There is intent to introduce one that rebalances every week, which will be a little bit, the performance is not as good from what I've heard. I haven't seen it yet, but also the volatility is down a little bit, plus the transaction costs go down a little bit as well. Matt Moran followed Speth, talked about the different option-based benchmarks. Matt Moran really was instrumental in getting the buy right index kind of pushed through at CBOE. He'd heard from clients they would love some sort of tool to show how option writing strategies would work. Matt talked about put right indexes.
He wants a tool, so he can't just look at like the returns of like a BXM that isn't a
there wasn't a BXM.
Yeah,
that's why they didn't really have something that showed that. And when I'm talking to managers that aren't doing an awful lot in options, I'll say just show what the BXM does, because it quantifies what you're trying to do for people. Matt introduced a study that actually got published this past week. And all of our studies, I guess maybe the guys that do these get paid by the letter for the title. 3 decades of option-based benchmark indices, with premium selling or buying, a performance analysis.
Try writing up articles about those, or try squeezing that into a tweet. It's a challenge. It's a challenge for us media folk.
So, and the Wilshire study talks about BXM, BXMD, the collar index, a weekly, a put protect index in PUT, and that study actually came out about a week and a half ago. And then there's another study that did just come out last week from Fund Evaluation Group, or this past week. I'm a little screwed up, as you said, from all the travel. I feel like today's Monday. That's how I feel.
Well, maybe on Irish time, you know how those time zones are so crazy. It could be the weekend could be over in Ireland already. We don't even know. It's a mystery how those time zones work.
So the Fund Evaluation Group, they got paid more because the title is Evaluating Options for Enhanced Risk-Adjusted Returns, CBOE Russell 2000 Option Benchmark Suite, and Case Studies on Fund Use of Options.
Yeah, I think the price jumps up to $100 a character in the title versus just in the body of the article. So that's why titles are where the money is. We all know that.
And this one shows that the CBOE Russell 2000 put right index has outperformed the Russell 2000 total return. Both of them, it's very difficult on radio for everybody to visualize all of this, but there's a blog up on our blog site about both of these papers, and cboe.com/benchmarks. You can download both of these papers and put them on your weekend reading stack.
Speaking of reading stacks, Mark's asking me here if you guys discussed a paper that you two may have collaborated on over there at RMC.
We did not talk about the study that Mark and I collaborated on, but an updated version of that is going to come out by the end of next month.
Somehow I'm guessing a study on the correlation of dancing ladies, shall we say euphemistically, and the VIX. Somehow I don't think it's going to make it out in the public presentation.
What do I need to do to get them to do a benchmark on the wheel? Because if they can do a benchmark that flips between selling straddles or selling strangles and risk reversals, they should be able to do a benchmark that flips between, BXY and put right, which is where I think, which wipes the floor with some of those.
Well, what you need to do is next time you're doing a CBOE TV thing and you're walking down the hall, pop into the little French lady's office.
I like that little French lady.
I do too. No, I think you should go talk to Catherine Chalin and see if I like how we're having a personal conversation here. But no, I mean pop in and talk to her about it because they're looking at more dynamic indexes. The one thing that Bill did say when he was doing his presentation was everything that we put out there, and I'm not saying that what you're talking about is not this, but he said everything that we put out there really is they want it to be simple. And I know the rules behind what you're talking about are simple, but all of our benchmark indexes are, they're pretty straightforward and have simple roles.
I'm kind of with Mark though. If they can wrap their heads around swapping between a risk reversal and a strangle based on some obscure variable to be determined, then they could certainly wrap their head around writing the put and then getting the stock or getting the underlying and then turning around and writing the call. And it is an attractive. It is an attractive issue, the wheel, or as our friends over there at our RCM call it, the triple income strategy.
There are so many people that use this wheel strategy, and the fact that there's no benchmark, I think, is shocking, actually.
Well, there was one more index I forgot to mention since we were talking about the simplicity of things. And this is another one that'll be formally announced in the next week or two. The Stabilis US Index. And you'll like this, Mark, because it sounds like something that you would actually think up. They take VIX versus TY VIX, and based on the spread between the two, they do weightings of the SPDR and the 7 to 10 year T-bond ETF. Or the core U.S. aggregate bond ETF, just depending on the weighting. If VIX is low and TY VIX is high, for instance, we mostly go into cash. If VIX is high and TY VIX is high, you'd put an awful lot into the 7 to 10 year T-bond ETF and very little into stocks. But they've got different regimes, and this thing rebalances on a regular basis. Taking a look at where Treasury VIX and U.S. equity market VIX are.
It is kind of funny, going back to Mark's earlier point. You're right. For a long time, they did focus very much on these, I wouldn't say simple, but easily palatable to a broad swath of the professional money management audience, these types of indices. The BXM, writing at the money calls on the SPX. Everyone can pretty much wrap their heads around that. The put right coming along, which is essentially flipping that coin, same exact thing, writing at the money puts. Then getting a little bit more involved, and now it seems like the shackles are off, for lack of a better word. They're really getting out there, swapping between strangles and risk reversals. This new you just mentioned it, Stabilis US. That's the new Stabilis US. You have the buffers. It's kind of interesting. You mentioned earlier the study. The tool you like to point to a lot to people who have who need data in this space is always the BXM. The one I always tend to refer to people who always ask us for data on the money management or the advisor side. I always refer them to the OIC series of collar studies, the loosening your collar, tightening your collar, because they did extensive research on that. They did it on the Qs and other products as well, the S and on other products, and it kind of shows how because that has that put component as well, obviously, which makes it less terrifying to a lot of the money management entities out there. And they might think that strategy doesn't outperform in a variety of scenarios, and OCC has a large amount of data to show that it actually does. It performs pretty well in a wide variety of scenarios. So he kind of gave us the rundown, Mr. Rhodes. Any surprises, any interesting hot topics or debate subjects that you encountered over there that kind of took you by surprise?
No, there always seems to be a theme coming out of the different risk management conferences, or something that keeps showing up.
Yeah, certainly in Florida, it was selling puts.
Yep.
Selling puts, sell puts, and then sell puts again.
Well, after it's funny because after the Florida conference, one of the CBOE people said that we should declare this the year of the put.
Everything old is new again. I'm not sure if you've heard that. I just coined that now for the first time.
Did you really?
But yes, selling puts. This is a new strategy, and now we have some data on it so people can get behind it.
The interesting theme was market disconnects. and how we seem to be experiencing more and more and more of those. And how many of them are going to be permanent, and how many of them are temporary, based on some sort of reversion back to normalcy at some time. Since we were in Europe, there was a little bit more discussion about negative rates than you would probably hear in the U.S., although that's a very global theme. But what kind of market disconnects are we going to experience as long as we're in a negative rate environment came up in multiple presentations.
That's the one thing I said. I've never been to the RMC Europe. That's the one question I would have for you, too. You mentioned kind of the negative rates. Were there any other obvious plays to the European audience, maybe mixing up the indices that they're looking at, maybe looking at different products? Was there anything uniquely European about this event that you wouldn't cover in the U.S. version, or was it just taking that type of content and just expanding the reach out to a relatively new audience?
Well, one of the great things, one of the things I really like about the European version is just about every presentation has co-presenters, and it's usually one person from Europe and one person from the U.S. And unless it's a European-specific presentation, like there was one on a volatility from a European point of view, which, needless to say, they focus just on that market. But it's interesting to see the different perspectives from both sides with respect to different types of strategies. One of the themes that came up a lot was there seems to be more risk. First off, a lot of speakers seem to feel that the market is not discounting financial market risk as much as it should be, that we're really downplaying. And we've been conditioned to downplay these things because central bank action came up a lot. Like, we get some sort that central banks seem to react more to what the markets are doing and less what they think is going on with the economy. And because of that, we in the financial markets have been conditioned to put it very simply, buy on weakness. And until it doesn't work anymore, it's going to keep working.
Now, it's interesting. I've always joked, but it does make a lot of sense to have an event over there in Europe, because I've often joked that a huge, some may say surprising amount of the SPX crowd, and certainly the VIX crowd as well, comes, you pick up that phone and there's a French accent on the other side of the phone. So there's clearly a strong European overlap between these products. So it kind of makes sense. Maybe the next one will be in Paris to speak directly to that Parisian French contingent out there. But interesting stuff. Before we dive off into all things VIX, you got more. Mr. Rhodes, fresh off the boat. Still, I was trying to give you a break, sir. There you go. Go ahead.
No, one last thing. Since you said maybe the next one will be in Paris, it's not. We did announce the next year.
Where is the next one?
It's going to be in London.
Oh.
It's going to be in suburban London, actually.
Oh, suburban London. Oh, yeah. That's no fun. You want to take the tube and all that fun stuff.
So yeah, since you mentioned the next one.
That means I have to...
Well, the next one's in Hong Kong, November 30th, December 1st. And then we're all going out to California. And then I think it's September 14th.
So it's going to be suburban London. It means I have to drive on surface streets in England, which is not happening because we'll kill. I'll kill everyone and their mother doing that. Mr. Greasy Meatball, before we dive into all things, what's going on this week? Anything else for on RMC Europe?
I'm looking forward to going out to London next year. That should be great. And the one thing I would ask Russell was of the non-CBOE speakers. Goldman usually says something interesting, or Susquehanna. Did anybody come out with anything interesting from an analyst side or a market condition side, or maybe even the VIX ETN side that raised your eyebrows or made you think?
The one of the sell side guys, I don't want to speak completely for them, so I won't say who it was, but one of the sell side guys made a pretty compelling argument with respect to being, for the rest of this year, being long V stocks and short VIX. And he said that V stocks is pretty much cheap relative to VIX on a technical basis. And then I talked to him a little bit after the presentation, and I interviewed him after the presentation for CBOE TV. And before we got going, I said, is this purely a V stocks is undervalued relative to VIX, or is there a fundamental view in behind this where you think that the next blow up is going to be Europe as opposed to the U.S. And of course, this was like a day and a half before the Deutsche Bank news. But he said that there's some fundamentals behind it as well.
If he had said European blow up, how prescient would he have looked in the rearview mirror there? So he was close. He had his opportunity to be the Nostradamus of the age.
So that came up, and then our buddy Chris Cole was the second day presenter, and oh my goodness, in his own very nice and good-natured way, he if you understood everything that he said, he could scare the bejesus out of you about the equity markets right now. He had nothing good to say.
Well, he of course had that infamous thing. We had him on the show not that long ago talking about his. What was he saying? It was the Fed's essentially dereliction of duty, for lack of a better word, and they were incentivizing a lot of this market uncertainty going forward. It was very, very interesting, surprisingly, shall we say, confrontational speak coming out of Chris and his team over there at Artemis, which is kind of interesting. If you know him, he's not really known for that kind of thing, so he must really be fired up to be doing that. Sounds like he's beating that drum yet again over there in RMC this week.
He really wasn't pointing the finger at any group. He was really talking more just statistically about how risky the market appears to be to him right now. And one of my favorite probably my favorite statement of the whole conference that came out of him was the way how much we've seen with respect to corporate buybacks among stocks in the S&P 500. He said basically we have seen a leveraged buyout of the S&P 500. And that's why stocks are where they are right now. As far as the index goes, I should.
Oh, the index.
Yeah.
Okay,
Yeah.
Interesting. I was going to say, how did he term that? But that is he's not known these days for making subtle comments. So we'll have to come back on again to rile people up. It's always fun. Speaking of riling people up, he's been known to do that time and again. Mr. Greasy Meatball, I gave you a chance to rest your vocal cords. I know you were very busy here on the option block program yesterday. Hopefully you're rested up now. So let's skip ahead now to what's been catching our eye this week in all things VIX, options, futures, cash, et cetera, and so on and so forth. Should be a good intro for you.
The Deutsche Bank debacle was really the big leader. And yesterday you and I were on the show, and it was setting up to be a disaster. And then magically the Justice Department comes out and they're going to announce some settlement, and I'm hearing that it's going to be nice, and Deutsche Bank's able to get a nice rally, and we are good to go. So it's pretty fascinating that the way VIX acted. I mean, it took the one thing that has been shocking and continues to be really, in my opinion, shocking is how wide the spread has been on VIX and relative to its October future. It is. Last I checked, I was talking to the Thompson twins, and they said it's in the 90. The spread is in the 98th percentile, and it still, as I look, has to be near that. I mean, we've got 19 days left of to expiration, and the spread is 2.5 points. 2.6 points between OCC and the OCC future and the VIX cash, and that's, I guess, it's Deutsche Bank related. There are some people that are very afraid, but there is a balloon about to pop in that October VIX future if VIX stays here, and it could make a nasty move, maybe around non-farms next week. There could be something very nasty, and we expect VIX to be stiff into non-farms, but I think by all imaginable records, this is especially stiff.
Yeah, 2.5 points right now between the cash, a little bit more actually between the cash and the OCC future. Nearly 3 handles between the cash and the no future. So all you who are about to write in saying, why is this call in December? Why is it? So why is the delta screw and everything else? Remember, the answer to all VIX questions is the VIX futures term structure. I should mention here at the top of the show, or in the middle of the show now, actually, we are of course streaming it on Friday, September 30th, right about middle of the session here, about 12:30 Central Time, and most of the major indices up about 1% on the day on light of the news Mark was just talking about, and VIX cash taking it on the chin, a little over a handle now, about 1 1/8 go back to the old school. 1 1/8 or so points, a little bit more now, south of the 13 handle. That said, I turn it back to you, Mr. Rhodes, who's patiently waving his hand in my face here like he's back in the classroom with some additional addendums to make his hand larger. Go for it, Mr. Rhodes.
I was waiting for the bear claw thing that I found on your desk.
We have all sorts of great tchotchkes in here.
It's awesome here. So, I was jet lagged and in a daze, and somebody texted me and said, "You see this Deutsche Bank stuff?" So I turned on Bloomberg, and then I took a look at some quotes, and I wasn't watching it all day like you guys, but man, the shape didn't really, even at the worst of yesterday, we were still in pretty steep contango, which I found pretty darn surprising. I actually was. And I was wrong, but I was kind of reading it as the market still braced, and I'll bet this thing follows through. It didn't, but that's the way I was reading the curve yesterday.
And I know you are fresh off the boat, so you haven't had a chance to keep your toes on all things market. But anything catching your eye outside of the legion, the myriad of presentations over there in Dublin this week?
We've done a lot of the October 5th VIX options. I didn't get my cool intro music yet, but we've traded about 30,000.
I wasn't going there yet. I was going to give you just your breakdown. If you want to dive right into your Russell's weekly rundown, we can do that. I hate to deprive you of your music.
I'm real surprised at how much volume we're doing in the October 5th options, and it looks like buyers of the October 5th 15 calls. So somebody's bracing for the weekend.
Since you teased it, sir, we will dive forthwith into Russell's weekly rundown. I was going to spare you. I thought you were fresh off the boat, but you want it, you got it, sir.
Now, Russell's weekly rundown.
All right, listeners, this is the portion of the program where Russell holds court at length, at least for the remaining 20 or so minutes of the program, regarding all things VIX weekly options that he had no time to watch this week. So, Mr. Rhodes, have at it, sir. Your wish is granted.
Make fun as you will, but there was a lot of talk about the VIX weeklies over in Europe and being able to, they love to say harvest volatility over on the continent.
It does sound a little bit more European that way, doesn't it?
But they talked about how they like to harvest volatility, and the weeklies are giving you that opportunity. Unfortunately, I'm looking at the front month or the front week futures right now. They are at a 70-cent premium, so there is a little bit to take advantage of there. Also, on the other side of that, they're at a 70-cent premium, and if you think that the Deutsche Bank thing suddenly turns into all kinds of lower Manhattan meetings and all that kind of stuff this weekend, they're giving you an opportunity to be prepared for such. As I mentioned, the 15 calls that expire next week, they've been trading pretty good. They've traded 12,000 contracts, which is a little bit more than the open interest, and they appear to mostly be trading on the offer. So I think and without being involved in a spread. So it looks to me like somebody's gearing up for a potential early week spike in volatility, at least using those options. It looks like there was a seller of the 13 puts as well. I'm sorry, the 13 and a half puts as well, but not nearly as many. So, that's the idea behind these guys, is being able to get something that gives you exposure that's somewhat close to spot VIX when you're concerned about a near-term event. And I do think that I don't know about you guys, and again, I was up all night, up all morning, however you want to put it, with the weird jet lag and everything. But I was talking to my wife about the Deutsche Bank thing and the headlines up there on Bloomberg TV, and I said, go back 8 years and cross out Deutsche Bank and put Bear Stearns in there, and it's kind of the same thing. It seems to be the same thing, at least on a headline basis.
It does have that similar headline quality, and I'm sure to a lot of the lay people out there, yeah, you're right. Swap one name out for the other, and it's, here we go again. Why are we going down this rabbit hole? Didn't we learn our lesson, in 2008 into 2009? Interesting, crazy week. I do like the notion of harvesting premium. I know our friends over there at OX Schwab like to call it that way as well, premium harvesting. It has a little bit more, I think, shall we say, nuance it sounds a little bit more nuanced than just blasting out at the bid and collecting all that you can. Russell's really in deep with the tchotchkes over here. I'll let him play on the desk for a little bit with our tchotchkes. While we move on to some other products, we are a little bit running long, listeners. We went deep into RMC, so we'll skip right ahead to another product that was exhibiting some interesting volatility, kind of coming off it now. That's out in the commodity space. Of course, crude oil. We had the big OPEC meeting, confab, call it what you will, this week, where there was a lot of interesting paper leading into it. Of course, we talked on the program multiple times in recent weeks how you kind of just cut and paste, OVX, OIV, of course, the VIX of USO and the VIX of WTI. A week after week, they were kind of languishing in that mid to a little bit high 30 handles there, well off their highs for the year, which were back in February when they burst into the 80 handle. So certainly about 50% of what they once were and kind of languishing there for some time. We were talking also about how the skew was pretty much all puts all the time, a little bit of life to calls, but nothing really. It was, you could do bearish risk reversals, or I should say bullish risk reversals out there all day long and do them pretty attractively. Well, this week that script kind of flipping a little bit. The OPEC people giving some life to the calls, giving some life to OVX and OIV as well, both of them spiking up to, I believe, about the 45 range this week before finally settling back today, back into the, what was the high? Almost 46, actually, on the 26th. So, quite a lofty time this week before settling back down right around 38.5 or so right now as we're winding down on the show here. And also, interestingly, we've been watching the skew in products like WTI and USO for the better part of a year and a half now, kind of wondering, when is the worm going to turn? When are the calls going to get some signs of life? And I don't know if we've hit that inflection point yet, but the calls certainly have a lot more life this week than they did a week or a month or 6 months ago. Here, you can find a bid for some near-term calls, people specking on some vacillation, but aside from that, you go out 2 months, 3 months, 6 months, and there was no love for any upside. That is not the case this week. Those calls getting a lot more rich compared to last week. So interesting stuff. Those bullish risk reversals nowhere near as compelling as they were about a week ago. I know, Mark, you like to watch USO mostly, but the vol moves out there had to attract you guys and probably got a lot of people chatting in the old pit chat this week.
Yeah, oil was definitely one we were watching. The other one we were really looking at was gold. GVZ, which is the gold vol index, is at 2-year lows. And gold has, despite kind of everything going on, has skidded to a nobody wants gold premium anymore. It's kind of shocking. So that was one. And yeah, oil, they gave us another opportunity to put 1x2s with that vol pop. And then how about OPEC finally, what was the word that Matt used yesterday?
Oh yeah, he couldn't. He said capitalization, but he meant capitulation.
Capulation.
Capulation. He was creating new words. That will be on the business show forthwith. Listen.
Yeah. How about OPEC finally capulating, so that they're giving up on, So oil might have found a floor here, although it could still be a problem for shale. We'll see.
Yeah, it'll be interesting. It'll be also interesting to see if they could keep all those myriad and disparate producers who are pumping as much oil as they can for dear life right now. They can get them to convince to actually go through with these cutbacks. That's always the other side of the OPEC coin. But yeah, you're right. Gold, speaking of other sides of the coin, gold kind of on the other side of the vol coin. OVX, OIV spiking, GVZ, which is, of course, the GLD VIX listeners hitting new lows all the time, it seems like. So no love, no life out there in gold, at least right now, whereas there is some interesting life and some interesting skew evolution out there in WTI and USO. So if you're interested in crude, this is an interesting week. Speaking of what you're interested in, it's time for you guys to take the horn because it's time for us to dive right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, everybody. I'm always promising we're going to get more of your questions on the show. We'll see how many we can get on this week. We love all the different places you take us. Got a bunch of questions coming in. First one from Facebook, which I like to see. For whatever reason, we get tons of questions via email, via the website, via Twitter, via everything else you can think of, StockTwits, via our app. Not so much from Facebook. So if you're on Facebook, you want to hit us up, go for it. Just like our friend here did, Mort Fury. I like that name. He says, my question is, guess right into it, I like it. In terms of skew, how do you think about the difference in the CBOE skew versus what he terms the CSFB? We'll get into what that exactly is. I'll explain it to you now. What he's referring to is, of course, the Credit Suisse First Boston, what they refer to as, I guess, their euphemistically, their fair barometer. It's a, let's see, essentially it measures how far out of the money you have to go to buy a 3-month put on the SPX. That's the same price as a 10% out of the money 3-month call option. He goes on to write, at its simplest, it appears CBOE's skew is 30-day, and the CSFB version is a 3-month measure of demand for downside protection versus upside calls. Other than the difference in time frame, how should one think about the two as indicators of market sentiment? Any thoughts would be greatly appreciated. Great question, Mort. Again, all you folks out there on Facebook who got questions, hit us up. This is an interesting one. I'm sure you probably get asked this all the time, Mr. Rhodes, but it's kind of one of the other names out there. They kind of glommed on that fear index, the fear barometer. I like that. That's a clever way to do it. But he's right. Time frame is obviously different, 3 months versus front month, so that's a clear, obvious difference. But other than that, they're kind of skinning the cat. It's a different way to skin the same kind of cat. They're still, when you're measuring calls versus puts on any sort of ratio like that, you're still measuring skew, which is what you're kind of interesting. But yeah, it's kind of a funky thing. One's leaning more towards the skew, one's leaning more towards your 30-day implied vol. So different indicators. You must get this, like I said, Mr. Rhodes, you must get this a lot over there in your classes. What is this fair barometer? You probably have a whole slide deck prepared on this, so I'll let you pull it up and run with it, unless you're too tired from coming off the boat.
No, I'm totally fine. At risk management, I probably saw 5 deviations of some sort of skew type index. And they just take different percentages or different time frames and those sorts of things. And they all basically kind of tell us the same thing. I don't think one's any better than the other or whatever. I like skew because it's a neat way to quantify it, and it quantifies it in one number. Which I think is easily definable, or maybe because I'm very closely familiar with it. But I don't think it's not like I think it's an either one or the other. I just think the other thing that you do want to take into account is the one that was just cited as a 3-month one. Whereas ours is a 30-day one. You can actually go as short as a week. So. It depends on what your outlook is or your time horizon of your outlook is with respect to which one you might want to use.
Yeah, I think a more appropriate analogy for his question would be a comparison between, he mentions it here, skew. So, he has the right analogy here. I was thinking he mentioned VIX at first, but yeah, it's skew. So, yeah, other than that, it's really a time frame issue. Other than that, there's not a heck of a lot of nuance aside from that. It's kind of... You're right. There's kind of different ways to skin this cat. Skew is a hot thing. It's quoted a lot of different ways. They choose that 3-month. You guys choose kind of that over 100 notation. I believe it's like 125 plus is typical notation for the skew index. So there's a lot of different ways to skin this cat. Actually, if you guys tune into our show later today, our TWIFO show, our friends over there at Quick Strike like to do what they call the quick skew. They actually kind of measure the movement of the put wing and the call wing independently, which I kind of like because you can kind of see what's going on independently of the two rather than just one number. So there's a lot of different ways to slice and dice skew. These are 2 of them. And yeah, the biggest difference aside from that really is time frame. All right, good question. I love the Facebook people coming strong this week. Let's see, we got time for a few more. Let's see, quick one. Comment from Emmanuel Wynn. We asked, what flavor would a VIX Slurpee be? And his answer is worthless a flavor. And no, it's not a flavor. I don't think it would be a very tasty flavor. If it was, it'd be gray. So him not feeling the love for our VIX, I forgot how we got on that topic last week, but yeah, our VIX Slurpee question was got a lot of interesting responses. That was just one of them. Speaking of responses, really quickly, Russell. Follow Russell on Twitter if you're not listening, because his face just jumped out at me in a very terrifying way. Totally threw me off my game. Yeah, we had our question of the week this week going out to you guys was, I think a clever one if we do say so ourselves. We asked people, given the debates, and we kind of last week, we're kind of dismissive of the impact Trump may have. A listener wrote in asking about kind of the Trump effect. We were kind of a little bit dismissive of it. It seemed like he was kind of in the rearview mirror a bit. And this week, new poll numbers coming out, the debates coming out. And all of a sudden, Trump is a more relevant factor than he was. And so we kind of asked you guys, how will the election impact VIX? Are we heading for a Trump-ocalypse? You like that? Or a Clintastrophe? Share your feelings. And we gave people four choices, obviously. Is it going to spike over 20 due to Trump? Will the VIX cash spike over 20 due to Clinton? Will it have no impact? So at the time we wrote this, it was about a 13. So we said if it stays in the 12 to 14 range, it'll be relatively no impact. Or a modest increase, which we termed a 15 to 20 range. I know you're on Twitter, so you're probably cheating, Mr. Rhodes. But
I'm not cheating.
What would your answer be, and what do you think is winning our poll? We still have a couple days left.
Everybody likes to blame Trump for everything, so I'm going with that.
That's probably a safe bet on both sides. Mr. Greasy Meatball, what do you think is winning the poll, and what is your vote?
Trump is winning, and my feeling is it's still to no effect.
So your feeling is no impact. Okay, interesting. So that's getting about 20% of the vote with no impact. So staying in that roughly 12 to 14 range on the VIX cash. The lowest is actually blaming Miss Clinton. No love for her. She's not going to make a spike over 20. Only 8%. 40% saying blame Trump is going to spike over 20, and 32% saying a modest increase. So if you take that together, three quarters actually saying there's going to be a decent impact on VIX as a result of this election going forward. Mr. Rhodes, you're raving your bear claw.
I just needless. Well, we had a speaker talk about the presidential election at Risk Management, and I can tell you that there's a fear over there of Trump winning. There really is. So I'm not going to get into the possibility. I'm not getting into any of that whatsoever. And I know you're in danger just when you say Clinton or Trump and you don't say anything else. So I'm not expressing an opinion. I am just repeating the vibe that I had that I got while I was over there. They think it's a reality. They do think it can happen now, and there is a real fear as to the repercussions if it does happen.
Well, according to the poll numbers this week, we were dismissive of his chances, but he's pulling to within spitting distance. Some may say tie. Some polls say he's pulling ahead in certain regions. So we'll see how the impact. I'm not sure if the debate impact has been fully measured yet, if he's going up or down as a result. But yeah, he's far more relevant than perhaps we even gave him credit for last week here on the program, and certainly perhaps to the dismay of a lot of our colleagues across the pond. All right, that's going to do it for the questions right now. We got to keep on rolling to our final segment, the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, listeners, welcome to the Crystal Ball. This is the portion of the show where we attempt to divine what the volatility gods hold in store for the coming week, where the VIX cash is going to be right around the end of the show. And as we finish the show, not quite as heartbreaking as last week, listeners, where I was winning spot on at the beginning of the show, and over the course of the show, it drifted right to where Mark Sebastian wrote, right to his strike. And so it was very demoralizing for me. But this week, a little bit different. Most of us were pretty much fading the impact of the debates this week, with the lone exception, the man who's been buying upside in VIX all year long. That is the corner office man, Mr. Rhodes. You were about 1340, you were saying this week, and as we're closing, we're just a little bit, right around 13 handle, just a tick under. So Price is Right rules, you actually lose, but we don't go by Price is Right rules here. We go by net closest. So you are the closest. Andrew was on last week for Mark. Andrew said 12.25, so he was about 3/4 of a point off, and I was fading it the hardest to the downside, 1160. And so my fading was a little bit too aggressive this week. That said, Mr. Rhodes, you get pride of place. Do you want to go first, or do you want to pick someone else to go first?
I'm going to make Mark Sebastian go first.
I was going to say, that's an easy one to pick. Which one are you picking? All right, Mr. Greasy Meatball, go forth and prosper, sir.
I'm going to go with this Deutsche Bank thing. It turns into more of a mess. Something everyone's expecting an awesome settlement this weekend. What if it's not that great? And what if more money leaves Deutsche Bank? What if another story leaks? Where does that go? I'm going to go this time next week in shocking fashion, 14.5.
Wow, that might be the first time you've really bought vol this year. I'm trying to think.
It might be.
You've been fading VIX cash pretty much, less like I have. I have been too. But you're buying into this. Interesting. Well, certainly the election is kind of lurking to add a little bit of vol.
Well,
and then
this one is there's something wrong with Deutsche Bank, and the Europeans are experts at creating a mess out of something that would have been easily solvable if they just got a little bit in front of it. So, I mean, if you see the way the Europeans are able to handle such great things as the country of Greece, Brexit, this could be a mess.
That's interesting. Buying vol, Mr. Greasy Meatball, one of my co-sellers, finally buying vol, Don Schlesinger. Turning over in his blackjack table as we speak. But yeah, interesting. I've been looking at this. I obviously faded pretty aggressive. I'm still going to fade it, but not as aggressively as last week. I don't know. The DB thing could turn into something. That could be the one fly in my ointment. But I think we'll be around these levels. I'll slightly lower to next week. I'm going to say 1260. So raise myself up a handle from last week. And Russ, I know you're the crazy buyer. So if Mark's buying 14.5, you got to be at 17.
Crazy buyer, never. No, I'm thinking 1370 or so, maybe a little bit higher from here, but not crazy buyer.
Wow, so Mark actually outpacing you to the upside. Mark outpacing you in the buying vol. This is a first for 2016.
No, really?
I think it might be. Unfortunately, you'll have to believe me because that music means we've come to the close of yet another exciting journey through the world of all things volatility. Went deep into CBOE RMC Europe. So if you couldn't make it, I know a lot of you guys couldn't. It's not easy to get out to Dublin, get the ticket and everything else. But we hopefully gave you a breakdown. There'll be a lot over there, obviously, on the CBOE website as well. You can surf on over there, check out a lot of the tabs for the conferences. They'll have a lot of the presentations up there. So you can see for yourself if any of that stuff really piqued your curiosity. And of course, we dove into all things VIX and some of the surprising developments therein. Also, out there in the commodity landscape, oil popping from a vol perspective, gold not so much. Got into some of your questions, skew versus skew, always interesting. Keep them up, particularly you Facebook folks. You got to pick up your end a little bit. I love the rest of you, Facebook. Start hitting us up, and then of course, a surprising turn of events here in the crystal ball. Mark the buyer this week. So since he's the buyer, I'll let him go first with his plugs for what's coming in the realm of all things option pit.
I was saying, got my. I'm more than halfway through with my next book, and I'm expecting to be done with that in the next, hopefully the next 3 weeks. Then we're gonna look to publish early next year. So be on the lookout for my next book.
And what's the title going to be?
I believe Trading Options for Edge, although that could change.
Trading Options for Edge. There you go, listeners. Stay tuned for that. Yeah, you have like 2 weeks to finish it, sir. So go forth and type furiously, and perhaps draw some graphs as well, because I know they like those visuals over there. All right, and Mr. Rhodes, you're back from all things CBOE RMC. People can tell people where they can find all that content if they are so inclined, as well as what's cooking in the land of all things CBOE Live Vol.
We're gonna do a little mini educational conference at CBOE on October 13th in the evening. I think you mentioned the RCM guys earlier. I'm gonna spend about 45 minutes talking about VIX, and then they're gonna bring in 4 of their managers to talk about their various strategies, and Larry McMillan's on there, and I think Matt Thompson as well. I've forgotten the other two at the moment.
So folks go to Options Institute to register for that?
No. I will tweet it in just you have to register through RCM. So
Okay.
I will tweet that as soon as I finish playing with this bear claw.
You're having way too much fun here in the studio, sir. May have to get you in the corner office next time. You're just enjoying yourself far too much. But yes, so check that out over there. Our friends at RCM, we like those folks as well. And of course, our friends over there at CBOE Live Vol. If you like all this data, we pretty much talk data all show long. Head on over to livevol.com. It's free. Try it out. Free trial. What you got to lose? Nothing. And of course, if you want some hardcore data, go to datashop.cboe.com to get your unique data needs on. And on behalf of Mr. Corner Office, a.k.a. Mr. Studio today, and Mr. Greasy Meatball, who's out in the satellite headquarters of all things Option Pit, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing to the show, and of course for sending in such great questions. Keep them coming, particularly you Facebook crew. You know who I'm talking to. And we'll see you next time right here on Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.